Now we are live on Facebook, we are on air, and our next speaker is Steve Kelso. The word is yours.
Hi, thank you. Hi, everybody. My name is Stephen Kelso, and I'm head of capital markets at ITI Capital. ITI is a multi-asset investment bank focused on emerging markets. We have about 200 people in 5 countries. We believe that digital assets are more relevant to more people in emerging markets than they are to many in developed markets. We believe that digital assets are an extension of the emerging markets investment phenomenon, which is essentially characterized by less efficient capital flows. At ITI, we consider digital assets as just another asset class. ITI specializes in fixed income, commodity, and equity finance, derivatives and structured products, DMA and electronic access to many emerging and developed markets and exchanges. Our digital asset trading business platform combines one of the biggest OTC crypto players in several emerging markets with a long-standing prime broker in traditional assets. And we would, of course, be delighted to hear from anyone looking to trade. What I'm going to talk about is our view on the multi-asset allocation we expect to see into digital assets for the post-COVID stage of the investment cycle. So first of all, what is multi-asset? Multi-asset investing has come to dominate traditional asset management since the great financial crisis. When rates were slashed during the zero and negative interest rate policy regimes, the bonds alone no longer sufficed to meet the liabilities of investors. Hence, investors were forced up the risk curve in increasing amounts into other asset classes beyond bonds. The GFC and the ensuing global policy responses radically changed the accepted risk-reward characteristics within asset classes and the dynamics of the relationships between asset classes. So, for example, equities became the go-to asset class for income, previously garnered from bond coupons, whilst bonds traded on negative yields in the anticipation only of capital growth, previously accessed via growth equities. Now, the first rule of risk management is diversification. Balanced funds had gained traction as long ago as the 1960s, with a static allocation of typically 60% to bonds, which were considered safe, and 40% allocation to equities, which were considered then higher risk growth assets. The sharp contraction in bond yields following the GFC drove a rapid evolution and expansion of multi-asset investing across a large array of constructs and strategies. Previously the domain of the hedge fund multi-strategy vehicles, global tactical asset allocation giants delivered much more sophisticated investment portfolios to retail and pension funds. Now, the significance of the UK market is pronounced. So the UK asset management industry is the second largest after the US at about £9 trillion. The UK represents about 37% of the European total. At the end of December 2017, it was bigger than France, Germany, and Switzerland put together. Institutional clients account for about 80% still, with pension funds being about 45% of the total AUM. And about 70 to 75% of the assets are still actively managed, down from 85% 10 years ago as passive investing and smart beta funds continue to gain ground globally. There are about 1,850 authorized investment firms in the UK, and the top 10 manage over 50% of the total assets. And these are all multi-asset managers. Also significant about the London market is that about 40% of the assets under management are managed for international investors. And London has been the main portal for capital flows between emerging markets and developed markets for 300 years. It's a similar story for Switzerland, and it's no coincidence why they have emerged as the 2 crypto capitals of Europe, London and particularly the Zug-Zurich area. The impact of the COVID and the whole pandemic on the economy and markets has obviously been brutal. US and European markets initially considered corona to be localized in China and Asia, and for the most part assumed it would pass like SARS. Then, of course, things took a sharp turn for the worse in March, compounded, of course, by the price war in oil, and the rest is history. 9.4% of companies in Spain went bankrupt in March alone, and economists and strategies now refer to this as the Great Corona Recession, the GCR. Back in the GFC, it took years for policymakers to debate and agree their choice of and use of weapons, such as quantitative easing, against the moral hazard of bailing out the banks. Back then, the US led the way, and very quickly the markets learned not to fight the Fed, as the S&P bottomed 6 months after Lehman collapsed in March 2009, and it rarely looked back. Today, policymakers can't help with the short-term to medium-term effects of social distancing, but they can seek to mitigate the household and corporate distress by providing a bridge for the economy. Again, the US has led the way. Congress approved massive stimulus whilst the Fed has slashed rates again with huge liquidity injections and unlimited quantitative easing to ease lending. Japan has announced combined monetary and fiscal stimulus totaling a massive 40% of GDP. And Europe's recovery fund, tabled at $500 billion, is being well received thus far. But household name companies are failing all over the world. Society now has a strengthening voice on issues of social responsibility and corporate tax avoidance. There are growing calls that governments and private sector need to work more closely together. Investment managers are dealing with the fastest bear market ever and need simple, transparent products to help them manage the risks of liquidity, leverage, and volatility. And this is where Bitcoin comes in. The tip of the spear of the multi-asset movement are the US endowment funds, led by the likes of David Swensen at Yale, who has pioneered the application of modern portfolio theory over his 35-year tenure. MIT, Harvard, and other endowments have all adopted the modern portfolio theory approach that Markowitz won his Nobel Prize for. These endowments announced that they had begun investing in digital assets 2 years ago, long before the GCR. The attraction was less the fear of missing out, but more the sober benefit of increased diversification from another asset class that was not totally correlated to gold, let alone equities, fixed income, commercial real estate, and the other asset classes. The definition of Bitcoin as digital gold is maturing today as the debate about its price drivers evolves. Gold investors point out that whilst Bitcoin resembles gold on the supply side, the demand side is very different, arguing that the value lies more in the network defining Bitcoin. Nonetheless, there is growing acceptance in the scarcity value that Bitcoin represents. At times like this, multi-asset managers are very much looking to their portfolio diversifiers to shore up performance of their funds. The 30% bounce in the S&P and similar rebounds in other asset classes from the March lows have put increased pressure on multi-asset managers to figure out quickly at what point they start to add risk again. All of this is happening at a much accelerated rate to the GFC, when investment and governance committees had much more time to pause and think. One of the most significant developments towards the institutional adoption of digital assets is, of course, Paul Tudor Jones' announcement that he has invested his fund in Bitcoin futures. It has been no secret that Tudor Jones and other successful macro managers have been personally invested in digital assets for years. But the groundbreaking development is that his firm has taken the non-trivial steps of navigating the internal and external processes required with stakeholders and investors and decided that the risk-reward opportunity makes sense now. Under the title of The Great Monetary Inflation, Tudor's letter to investors this month sets out in detail his thesis for Bitcoin, as COVID-19 is a one-of-a-kind virus, he says, that has triggered a one-of-a-kind policy response globally. Tudor draws parallels with the rise and fall and subsequent takeoff of gold back in the late 70s, when access had just been opened up via the futures market. Tudor's loud and proud approach has both de-risked the personal career choice for traditional investment managers and made the case very clearly for attention to be paid to the potential onset of inflation that's on the horizon. When Bitcoin collapsed in March, skeptics were quick to question the safe haven status. However, remember that gold also fell 30% during the GFC from $1,000 to $700 before going on to nearly triple at $1,900. Morgan Stanley's chief economist has taken a very bold position, claiming that inflation will make a comeback again in this investment cycle after 30 years. He states that the aggressive, coordinated expansion of monetary and fiscal policy will be reflationary, and Morgan Stanley see a high risk that policymakers will prolong this response and also disrupt the structural disinflationary forces of the last 30 years, which they refer to as the 3 Ts of big tech, trade, and industry titans dominating their sectors. Morgan Stanley called that inflationary pressures will emerge from 2022, preceded by growing concerns about the global economic outlook. So in summary, at ITI, we see a growing interest from sophisticated investors and institutional clients starting to build positions in digital assets, particularly Bitcoin, in dollars, but also in euro and sterling. These are sophisticated investors many of whom were buying gold in euros and sterling, which was a hedge fund favorite trade during the GFC and also the European crisis of 2012. There are growing expectations for Bitcoin to continue showing a similar path at this juncture. However, not just sophisticated hedge funds, family offices, but the largest multi-asset managers are also now increasingly paying attention. Alpima, which is a research consultant to several household name asset managers, has powerful research on the performance benefits from allocating a modest low-digit percentage of Bitcoin to a range of multi-asset portfolios of varying complexity. So we think with career risk reduced, inflation risks increased, access improved to the asset class, and an asset, very importantly, that has such high octane upside potential without leverage, we believe that we will see a sharp increase in the adoption of digital assets led by Bitcoin by multi-asset managers. Thank you for your time.
Steve, you have a couple of minutes maybe for one of the questions from our audience. Yes,
sure.
Thank you for your great speech. Yes, I have to check it out. Just wait a second, please. It's not so easy for me. I'm sorry. Yes, a lot
no
of
problem.
pages. Yeah. Okay, what kind of question I have? You are talked about multi-asset allocation. How do you see how it's going to be used after this COVID? What's happening? What's going to be changed? Because blockchain industry, it already appears much more than 5 to 6 years. I'm talking about smart contracts. I'm talking about Ethereum platform. What's going to be changed?
On the multi-asset side, I think Bitcoin is very clearly going to dominate with the big multi-asset managers because of this inflation. I hesitate to use the word hedge, but certainly a diversifier that is not 100% correlated to gold. So I think that is clearly what led to those endowments entering the space 2 years ago. And I think now more of the multi-asset community is getting that same message. You mentioned smart contracts and other digital assets though. And again, one of the big dynamics that is coming out of the market's reaction, and obviously this 30% higher knee jerk we've seen in the S&P, but right across risk assets, is that actually the primary market has been very strong. So of course now with so many companies in any sector you care to mention distressed and in need of a lifeline, these companies are in very, if they're not in dire need to raise money, they certainly have CFOs who are experienced enough to know that they should be raising money when they can. And again, I think of the 3 chessboards in digital assets, the one that has actually moved the most for me in terms of an expectation of success and sort of short to medium term is that of tokenization. And I can see a growing number of certainly the sell side investment bank community, who of course, to whom securitization has been their bread and butter for decades. I can see now a lot of these people realizing that we're not talking about revolutionary digital assets here. We're talking about an evolution to, you know, one of the mainstays of finance for the last 40, 50 years, right? So I can see that a lot of these people will start to appreciate, rather than costing, say, $500,000 to list their equity to IPO, suddenly now actually it's a fraction of that. And furthermore, even 12 months ago, certainly 15 months ago, I had not come across a platform that I could put my hand on heart and say, wow, okay, I really believe that, you know, this can now work. And actually that is changing rapidly. And I think now there's clearly a race to the line in different jurisdictions about who's going to be first to that. So I think this dawn of the digital asset era is absolutely upon us as well. But I don't believe that those will be the first assets necessarily to be included by the big multi-asset managers.
Okay, sure. Steve, thank you for your time. Thank you for your great speech. I really appreciate it. What's your mind thoughts? Yes, now we have to go out of our on-air channel and have to go forward to our next speaker. Steve, once more time, thanks a lot for you, and see you a bit later, or maybe on another conferences as well.
Been a pleasure. Thanks, guys.